Sridhar Sivaram, Investment Director at Enam Holdings, joins us. Sridhar, good morning. Thanks a lot for dropping by.
Yeah.
You've been cautious, obviously, because earnings have not shown what the market is expecting. What would you do now? The market continues to surge on liquidity despite valuation challenges.
Yeah, so we were actually very cautious till last year. During Demon, when we did our ground check, what emerged was that the ground reality was slightly better for the listed space, the organized guys, and not so good for the unorganized guys. So we actually turned our views somewhere at that time, and our view currently is that, as Sonia mentioned, that this market will continue to climb wall of worries. And as it turned out that FIIs and domestics entering the year were positioned very badly. Both FIIs sold out during the demand period. Domestics were getting a lot of inflows but were not putting in the money because of various issues, including fears of what will come in the budget. And as a result, the positioning of the market was very bad. So we think that, one, we think the earnings weren't as bad. So if you see the actual results of the previous quarter, earnings weren't as bad. And we think the earnings going forward will surprise people. So we are actually very positive on the market, and we think it's time to stay really long.
As early as fourth quarter, earnings could improve?
So our view is that next year we'll see a 20% earnings growth. And a large part of that we think is because of the interest rate transmission. That has finally happened. So we met possibly 50, 100 companies in the last 3 months. And it's been a unanimous view from everyone that finally they've seen transmission. And this is not small transmission. It's like 100, 150, 200 basis points, depending on the credibility of the company. And our calculation shows that a 1% transmission leads to a 10% earnings growth for the market. Because if you see a rough maths, total corporate credit is about 40 trillion. And 1% of that is 400 billion. And the corporate profitability pool total is about 4 trillion. So 400 billion profit more that the industry gets purely because of 1% change. Now this is a very simplistic calculation. Not everybody gets it because there are cash rich companies and there are companies which are poor. Yeah, but that's the broad maths. A 1% reduction in interest rate will result in 10% profit growth. This is also because India's corporate profitability to GDP is at a 10-year low. So this is also because the corporate profits over the last 3-4 years haven't grown. So it's a combination of factors. So we think that interest rates itself can give you a 10% boost to earnings, and the normal profits that you get will be around, say, 10%. So you could end up with a 20% earnings growth, which I think will surprise the market.
Okay, Sridhar, good morning. But this 20% of course will come on low base. For the market, important point would be the CAGR. You have done any analysis on what we can have on that front?
Yeah, so actually when you put these things on a spreadsheet, there are companies which could have really absurd earnings growth. Because when I said 1%, 10%, there are companies where the profit is so low that when you save something on interest cost to this extent, the actual impact on the profitability is quite absurd. You can't even put it, and I don't blame the analysts, can't even put it on the numbers. So we think there's enough surprise waiting to happen for next year, and which is why we are slightly more bullish on the cyclical part of the economy right now. That there have been a lot of work that has gone on the cyclical side, be it on the roads, railways, and we keep complaining that we haven't seen anything on the ground. These things take time. So we're almost 3 years for the new government. And as we speak to people on the ground, the impact of that is being seen. So we think that we will see some of the benefits even of that as we go into the next year.
Okay, I haven't heard you as optimistic as you are now in a very long time.
Yes.
So I think you've brightened up our Friday morning by being so optimistic. But I'm just going to play the devil's advocate here.
Why not?
Couple of issues, right? Monsoons, there's a bit of a fear this time. Crude is spiking up now because of some geopolitical risks. You think those are just issues on the margin and will not affect the market as a whole?
So I think monsoon as a factor for the market is always overemphasized. The net result hasn't been so great for the same year. So you go back in history and check 10 years and you see drought years and see what happened. There are many years when you've had very poor monsoon, but markets have done well. So there are many other factors in play. I also think that last year when we had poor monsoon for many years, many of the states have done a lot of work on the ground to improve the groundwater level. In fact, desilting of some of the lakes and stuff. Maharashtra and MP in particular have done a lot of work. I think because of a lot of the good work, even if there's a poor monsoon, the feedback that we get from on the ground is that we will see through this year, because last year was such an outstanding rain and they have done so much work on groundwater conservation that we may not have such an impact. As far as crude is concerned, if there is a risk to the market, is a risk from outside, geopolitical risk or something that happens in the US or something like that. But keep in mind that currency is appreciated, that helps our inflation. So it's a double-edged sword. But I think on the ground, what I'm seeing right now, there are more positives than negatives, and there are more skeptics than optimists. Okay. So I think at the balance, when you see everybody euphoric, you know something is wrong. This rally, I think most people have missed. So I think there is always reason to say that earnings haven't come, this will not happen. I think that good times are ahead.
Good for optimism. Well, you're clearly making an argument for cyclicals with your interest rate and your
domestic place predominantly.
Okay, so what would that be? Let's start with the financials, which are obvious cyclical plays.
Yeah.
Which sector would you still go with? NBFCs, or would you go with only private banks, or do public sector banks deserve?
So the first is, I'll give a warning that I'm seriously concerned about the MFI business. So if you see, ICRA has downgraded Jan Lakshmi, and I don't think people have really taken note. Their NPAs have gone from 0.7 to 11% from November to February.
So demon impact maybe.
It is a demon impact. Keep in mind that microfinance is subprime lending. People forget that because you had such good NPA performance, or the credibility of this sector has been so good that people forget that this is subprime lending. And when you get a systemic shock, that's the most dangerous thing that can happen. What we hear is there are problems in 5 states, which includes UP, Maharashtra, Karnataka, Tamil Nadu and Bengal. Now that's a fairly large number in terms of the impact that will have. So I don't think any of them will escape this. Some have come out already, like Bharat Financial, Jan Lakshmi, because the credit rating has downgraded. CRISIL has issued a warning. I think for whatever reason the market's ignoring credit rating warnings. I'm a bit surprised, because that is the biggest warning for me, when a credit rating wakes up and downgrades. So that's the warning part on this. But I think the good part is that the private banks, I still see that they will benefit, and selectively on public sector, because some of them have taken so much of haircut and provisioning that we could see some write backs. We saw early signs of write back, and if the economy does turn even little bit, we could see some benefit. And some effort is happening, but it's like 2 steps forward, 1 step backward. So the IDBI incident didn't help the whole cause. So I cannot, say that everything is great, but at the margin, financials is a place to, play selectively.
Okay. So would you go with companies which have assets, have decent EBITDA, but the interest cost is taking most of that away?
So that's a very dangerous part to go. But a lot of opportunities are there, which is if companies are delevering and you know that the management is serious about it, and they also having benefit of if the business is also looking up. And so you have 3 factors. One is the delever factor when they're selling assets, the other is falling interest rate, and then the business itself looking up.
So like steel, for example, would be
part
of
I would
that?
say commodities, I will not want to specifically, yes, there are selective pockets in steel, but there is interesting options in commodity, in cement, in construction, in capital goods, chemicals in some of the cases. We are seeing a lot of opportunities here where some of these factors are playing out, and the impact on earnings is going to be disproportionate for F18.
Okay. Yesterday we spoke to the Soba developers guy, and for the first time we got a ground report of how the Awas Yojana could genuinely mean a lot of buyers for that probably 10 to 15 lakh category of houses. Is that a theme you believe, and how will you play it?
So I had an opportunity to speak to the NHB chairman also. I think this is an outstanding scheme because one, they haven't restricted, this is not a restrictive scheme. This is an open-ended scheme, even though the provision in the budget is only said 2,500 crores. In my view, the government will need to budget for 30,000 crores. Because if you see the run rate on this, roughly that's the match. So a person who's taking a housing today gets an upfront benefit of 2.5 lakh rupees. And from what I understand, this goes into his account. He could actually use it for any purpose. So it's not restrictive as if it has to go into the loan account itself. So it actually gives him the benefit to use that for some other purpose. So this is a subvention that the government is giving, and it will benefit people in the smaller towns, because 18 lakhs and the maximum loan you can get is about 3.5 times your salary. So the cap is the salary, not the value of the property. So 18 lakhs into 3, so roughly about 70 odd lakhs is the max property price. 70 to 80 lakhs, suppose you're also putting 10 lakhs of your own. But that's a fairly decent amount for any property outside Mumbai and Delhi. And you're going to get 2.5 lakh rupees back. So almost like a subvention that you're getting into your account. I think it's a brilliant scheme. It is restricted only for the current year. Keep in mind that real estate has a disproportionate impact on employment. It generates a lot of employment. So I think this is a very well thought out scheme. I don't think the markets really appreciated the impact of this. And I'm not even counting all this. When I talked about the 20% earnings growth, I'm not even speaking of some of these schemes that the government has launched. I think this is a brilliant scheme.
Okay, before we run out of time, you did mention that you like infrastructure capital goods. After a very long time, I think after 1 or 2 years, I'm hearing a lot of experts talk about a pickup in the capex cycle.
Right.
But have you had any or seen any anecdotal evidence of a real pickup in capex?
So very early signs. We do think that there is a pent-up demand in consumer discretionary. We saw that with the last 2 days of the year when there was a steep discount, and you yourself guys have carried some story on that everything was sold out. So there is a pent-up demand as far as consumer discretionary is concerned. And as this pent-up demand plays out in the market, we will see capex coming. We're seeing early signs of capex. Keep in mind that when interest rates do fall the way it is for the corporate, it does help him to think about the next capex, because we've been talking about this poor capacity utilization for 3 years. Some of them have got utilized as we speak. So most promoters would have to think about the next capex at least 18 months before they actually need it. And we are seeing early signs of that. I won't say that this is really everybody is putting up plans right now, but we are seeing early signs. And as you said, the markets climb wall of worries. This is one of the worry that people have, that capex cycle is not picking up. But I think on the ground things are happening. When the market's up another 10%, that time most people will come and say capex cycle has.
Okay. Thank you very much, Sridhar, for speaking with us this morning and finalizing so many sectors for us.
Thank you.
Thanks a lot.